So one of the biggest claims being made about this year's federal budget is that property prices are going to crash because of changes to negative gearing, capital gains tax, and even more recently, self-managed super funds no longer being able to buy residential investment property. But rather than listen to the politicians and economists or the property commentators and people on social media, I want to go straight to the source and read the budget paper for what it is. So after reading the budget, there's one thing that stood out in particular to me. The government's own budget papers are effectively saying that Australia still has a housing supply problem. So I'm going to unpack everything that is in the budget and what it has to say about housing in Australia. At a high level, we'll go through how population growth is still increasing, how Treasury says that housing supply needs to respond better to demand, how the government is still spending money to increase supply, and how Treasury expects more homes to be built, but still being significant constraints to supply at the same time. We'll also go through how the rental market is still extremely tight and why rents will tend to rise due to a lower vacancy rate, and we'll go through what Treasury actually believe will happen to property prices as well. We'll go over housing supply, and overall I'll provide a bit of a takeaway on everything, and we'll go through the specific sections of the budget and what it says exactly, so not to misinterpret in any way. Now, the first thing I considered when looking at the budget paper was population growth. So if we fast forward to page 70, so the first thing I looked at when looking at the budget paper was around population growth, and the first thing you need to consider is the demand for property in the area, and that comes with population. The more people we have, the more demand for housing. And so on page 78 of the budget, it talks around how net overseas migration has declined around 45% from its peak in 22-23 and is forecasting continued declining through to 27-28. Net overseas migration is forecast to be moderately higher than previously expected in 25-26 and 26-27, which reflects that migrants on temporary visas are departing Australia at lower rates than in the past. Arrivals of New Zealand citizens are also expecting to remain strong, reflecting Australia's relatively favourable labour market conditions. Migration policy changes in this budget will place downward pressure on net overseas migration. However, even though we have falling migration indicated from the budget, the population forecasts are still greater than historical averages. We are looking at an outcome of 305 net overseas migrants in the 24-25 year. This financial year, 25-26, a slight reduction to 295. In 26-27, next financial year, 245. And then 27-28 to 25. And then in the years beyond that, net overseas migration is forecast to be 225,000 in 28-29 and 29-30. Just think about that for a moment. Even though we have reducing net overseas migration, it's still higher than historical averages. Let's look at how population has grown over the last 45 years. In 1981, we had about 15 million Australians. Fast forward to today, we have just ticked over 28 million people. And in the next 20 years, we're expected to have 36 million people. And 20 years after that, we're expected to have 44 million people. And in the 2071, in approximately 45 years, we'll have just under 46 million people. Now, if you have a look at the historical averages over the last 5 years, considering towards the end of COVID, total growth was around 70,000 in the December 2020 quarter. Just looking at this ABS data, 70,000 people in terms of total growth for the December 2021 quarter. And then you can see quarterly averages of around about 120, increasing to 190, 170 in the quarter, 156 in the quarter, and then tapering off back down. So we're at an average of around about 100,000 people per quarter over the last few years, to put it lightly. Now, when you average that out and consider that over a year, especially a financial year, we're seeing averages of around about 250,000 regardless, which is actually much higher than net overseas long-term averages that we see here of 137, 240,000, 250,000, and then the mass migration that we've had over the last few years peaking at 555,000. So either way you look at it, population growth seems to be higher than long-term averages in terms of net overseas migration, even though it's reducing. Now, one of the most important sentences in the budget appears on page 158. To achieve lasting improvements in housing affordability, housing supply needs to better respond to demand. This budget adds a new $2 billion initiative to the government's now over $47 billion Housing Homes for Australia plan that fast-tracks housing-enabled infrastructure projects. This will support up to 65,000 new homes over the next decade. As part of this initiative, further planning, zoning, and productivity reforms will be required of states and territory. Further structural reforms to address barriers will enhance the effectiveness of the supply side on the housing market. This ambitious set of reforms has the potential to support tens of thousands of additional homes. Now, this isn't my opinion. This is Treasury's own assessment. In other words, affordability isn't just a demand problem, it's a supply problem as well. People can't afford to supply new homes. And in essence, effectively, this budget is acknowledging that Australia hasn't added enough supply to the market in order to keep pace with population growth. Now, this is Catality's monthly housing chart pack for the month of June. And effectively, it shows the monthly house versus unit approvals nationally. And what you can see are a couple of troughs here in early 2018, 2019, and late 2022, early 2023, in terms of housing approvals, how they're historically below the decade-long average. And then you can see for the most part that unit approvals have been below the decade-long average as well. Long story short, we're not approving as much as we used to. Now, approval rates have increased since April 2023. And for the first time since probably 2022, we're seeing that we're producing more than the decade-long average. Although that being said, we're still seeing more and more people come to the country at a rate of around about 225 to 250,000 people year on year. Assuming that there's about 2.5 people per dwelling, that means that they're going to occupy 100,000 homes per year. Now, what's important to note is that the budget still admits that the government is spending billions of dollars to increase supply. So if supply wasn't a problem, why would we be spending $2 billion and adding that to the $47 billion to support 65,000 new homes over the next decade. Looking further into supply increases, and dwelling investment is forecasted to grow by 5% in the year 2025-2026 as strong commencements increase in the pipeline of work under construction. You can see here the referencing chart 2.10, the number of private sector dwellings under construction. This has increased since December 2005 from around about 100,000 to December 2025, we're sitting just shy of 250,000. Dwelling investment is forecast to increase to around about $150 billion in the year 27-28. So Treasury is saying that with strong building approvals, dwelling commencement, and housing credit growth are all supporting the construction industry. Now, this is important because the government is telling us that they expect more homes to be built and not fewer, but there's still significant constraints. Treasury admit that building homes isn't exactly easy right now, with supply chain disruptions caused by conflict in the Middle East posing downside risk. But the budget paper also indicates that there's some downside risk as well, such as the conflict in the Middle East causing disruption to supply side and higher cost in PVC materials. This has increased plumbing material costs by around 30%. There have been sustained increases in fuel and other construction input costs across the housing supply chain, which will create challenges for project feasibility and cash flow management for businesses in the industry, particularly those with fixed price contracts. So there's still few obstacles that are causing issues to the supply side. Treasury acknowledges that the rental market is still extremely tight. In the rental market, record low vacancy rates and construction costs have both contributed to rental inflation. Over time, growth in dwelling investment will add to the dwelling stock and help ease pressures. The record low vacancy rate means that there's very few rental properties remaining vacant. When vacancy rates are low, tenants compete for remaining properties, and this generally pushes prices up. This is supply and demand 101. So overall, what do Treasury and the budget have to say about the overall housing market? So Treasury modeling suggests that house prices will temporarily grow by around 2% less over a couple of years relative to no tax policy change. For comparison, on average, housing prices have grown at 6% per year since 2000. This means that a buyer purchasing a home at the current national median price would save around $19,000. This improvement in affordability and lower investor demand is expected to shift the ownership mix towards owner-occupiers. Treasury modeling suggests that the reform will increase the owner share of the housing market, resulting in 75,000 additional owner-occupiers over the next decade. This is the equivalent to reversing around 10 years of declines in home ownership rates. If we have a look at SQM research at the occupancy types, we can see here that owned outright in 1991 was around 45%, but the number of mortgage holders was around 29%. So effectively, this was a 75% owner-occupier rate. If we have a look at the number of rented properties, however, 1991 was 25%, 96, 24%, 2001, 21%, 21% in 2006, 2011, 24.6%, 2016, 27%, 2021 back down to 23%, a massive drop. And then moving to 2026, we're projected to look at around 24.25%. Not a massive increase towards the rented/investor type. What you can see is that mortgage rates are increasing as the biggest shift in demographics, almost overtaking those properties that are owned outright. The long story short, if we put politics aside and focus solely on what Treasury has written in the budget, the message is actually quite simple. Demand is slowing but still there. It's not disappearing entirely. Australia is still expected to add hundreds of thousands of people every year. At the same time, Treasury acknowledges that housing supply needs to improve because rental vacancy rates remain extremely low and construction costs remain high. Infrastructure spend is needed to unlock more housing. Now, to me, the budget doesn't describe a market that's moving into oversupply. It actually describes a market where governments are still trying to solve a housing shortage that already exists. And whether you agree with the tax changes or not, the government's own budget papers suggest that housing supply remains one of the toughest challenges facing Australia over the next decade. Now, if you don't agree with me, I'm happy for you to read the budget for yourself. Do me one favor, don't rely on the headlines. Go straight to the source. Make up your own mind. And at the end of the day, the supply and demand fundamentals still call for investors to make rental properties available. Hope you've taken something away from this video. Please don't hesitate to reach out if you have any questions or want to talk about investing in property. Thanks again. Have a great day.